It's a question that I've seen posed all over the place on GB News, by Thomas Piketty, the French economist, even in the In Gold We Trust report, but I am yet to have a satisfactory answer. Why can't central bankers just buy all the debt? That is the question, and I'm joined by the investment director of UK Independent Wealth, Rob Marstrand, to try and answer it for me. Now, I'm especially interested in Rob's answer because he is in Argentina, and Argentina is sort of a response to the question in and of itself, isn't it, Rob?
Yeah, hi, Nick. Well, absolutely. I'll come on to Argentina in a minute. But in answer to your question, why can't central bankers just buy all the debt? In a nutshell, I would say the answer is because even stupid people would then realize that they are directly financing the government. So they're paying for the government's lack of money for all its profligate spending. Now, as things stand, whether it's the Bank of England, the Fed, or whichever other country is up to this, or central bank is up to this, they have plausible deniability, you might say. So they can, by using the sort of smoke and mirrors of funneling money through banks, which then buy bonds from someone else, which then, flows it through, they can claim that it's something else, that it's to do with controlling the yield curve or stimulating the economy. But the reality is the money eventually flows to the government through this smoke and mirrors. Now, how do we know that? Well, let's look at two extremes and consider those. So if the central banks, like the Bank of England, do absolutely zero QE, so they're buying no gilts, so no government bond securities, then it's very, very clear that they're not financing the government directly. If they're to buy 100% and nobody else is buying the new debt that the government issues, it's very, very clear that they're 100% financing the deficit of the government, the budget deficit. Now, where we are now, we're somewhere in the middle. I don't know what the number is exactly today, but I think it's probably around 40%-ish of all the government debt is owned by the Bank of England, something of that order. So it's fair to say we're somewhere between not financing anything of the deficit and financing all of the deficit. So I would argue they're financing a large portion of the deficit. But still, a number of people think, well, it's okay because it's all through it's through the bond markets. It's not directly truckloads of cash driven from the Bank of England over to number 11 Downing Street for Rishi Sunak to use. So that's my view anyway.
The part of that fascinates me is it used to be uncertain whether central banks are financing governments, whether central banks are buying government bonds to finance the government, or whether they're doing it as part of their monetary policy, as they like to claim. But I think over the last few years, especially because of COVID, it has become almost blatantly obvious that central banks are and do finance the governments of the world. That's especially obvious in places inside the Eurozone. I think they're buying more than the net issuance of government debt, the ECB is. And also we had the Ways and Means facility of the Bank of England financing the government. And I think it was the Bank of England governor or the treasurer who said that if the central bank had not supported the government during those initial months of the COVID pandemic, then the government could have gone bust. So I think we're a step beyond that. I think we're now in this world where people have acknowledged that central bankers are financing governments. They have this plausible deniability still because they're also doing it to conduct monetary policy. But the net effect is clear, in my view. What's wrong with it, though? Why can't this not just finance 40% of the government's deficit, but 100% like in parts of the Eurozone, or even more? Why can't they just bail out the banking system as well? And why not the housing, the mortgage debt as well, and the student loans and everything? Why can't central bankers just buy all of the debt? What's wrong with it?
Well, maybe I'll come back to that in a second, but let's just step back to when they started this whole process, just very briefly. So the emergency QE after the global financial crisis, when they started in, whenever it was, 2009, 2010, the issue was that the banks themselves, the commercial banks, were in such dire straits that they were shrinking their balance sheets. And that meant that the deposits in the system, the loans and the deposits in the banking system were going down, the ones that are created in the ordinary course of events. So the QE money that was printed by the Bank of England and the Fed and everyone else created deposits out of thin air. And those deposits now, I would argue that was always funding government indirectly. But that money goes to the government then spends it, and that goes back into the economy, and it goes into private hands, whether it's companies initially that support, or employees, the people that work in the government. They get paid their salary, they get their money, and then they go off and spend it on other things. So that propped up the system and it kept the deposits level and or growing a little bit. But now we've got to a point where the commercial banks are fixed, essentially. They're making good profits. If you look at Lloyds Bank or other UK banks, in the first half of this year, they're making good profits for the first time in over a decade. That means they're in great shape to expand their balance sheets again and increase lending and increase the money supply. So now you've got the private sector can now increase the money supply, and you've got the central banks still rapidly increasing the money supply. So deposits are going up at quite a clip. Now that becomes inflationary. Now, going back to your question, we can explore inflation further if you want, but going back to your question, why don't you do it? Well, you don't do it because history tells us that when central banks have a free rein just to print as much money as they like for the government, then you get high inflation and or hyperinflation. Now, as you mentioned, I'm in Argentina. Inflation rate is about 50% a year. That's 50. So people panicking when inflation goes from 2% to 2.1 or 2.3 or 2.4. Here, it's, will this month be annualized at 30, 40, 50, 60%? What was inflation last year? Now, that's been going on for about the last, well, I would say 5 years, probably a little bit more than that. Although at various points, the government does lie even more than other governments about the numbers. But why does that happen? I mean, the central bank literally, as part of this process, the central bank literally does just create pesos, which are the local currency, and hand them to the government. And the government goes out and spends them on, well, most of it gets spent on welfare down here, unfortunately. But that creates inflation. And, it's the inevitable consequence. When you have too much money chasing too few things, you get a devaluing currency and rapid price rises. And, more extreme versions happen in places like Venezuela. We've seen Zimbabwe in the past, where you used to be able to get $100 trillion Zimbabwean dollar note, which was absolutely worthless. This is what happens when central banks have free rein to print money. The currency devalues and you get inflation.
One of the most interesting ways that I've heard you speak about this or refer to this is that the UK and the US and the developed world, we are now following the playbook of failed states. The idea that this is how usually less well-governed nations get things wrong. They have a central bank, which is nominally independent of the government, but the government gets in such strife financially and economically that the central banker is forced to choose between either bankrupting the government or going along with the government spending and triggering inflation. And it seems to me we're at the same threshold now in the UK, in the US, and in Europe, where central bankers face that same choice. Are they going to finance the government, or are they going to let the government go bust in order to protect their inflation mandate? Which way do you think they would choose in the end?
Yeah, I mean, look, they've painted themselves into a corner years ago. Essentially, pretty much, or no, I'd say all developed countries, all meaningfully sized developed countries anyway, have very, very high debt burdens, both in the public sector and the private sector. So governments, households, corporations, all have very high debts. Now, to control inflation, if it takes off, what you have to do is you have to try and contain the money supply. And you usually achieve that by raising interest rates, which sort of cuts off demand for new borrowing, essentially. And obviously, in this case, you'd have to stop QE, which is another way of inflating the money supply. Now, the problem is if interest rates go up, and if the bond market normalizes. So in the normal world, bond yields, government bond yields, should be inflation plus something. So they should be, let's say if inflation is running at 2.5% a year, you'd expect to make 1.5% to 2% above that, so that you get a real, as in above inflation, return on your money. Currently, the yields are so compressed by the hundreds of billions or trillions that these central banks have been printing around the world, that bond investors make less than inflation. They're kind of guaranteed almost, unless we get massive deflation, which is unlikely. But they make essentially negative real returns, so below inflation. Now, if the bond market normalizes and yields go back to where they historically were, which is this sort of 1.5% to 2% above inflation, the bond market crashes. Corporate borrowing becomes expensive, mortgages become very expensive, all types of lending becomes very expensive, and the economy crashes. So what central bank wants to be responsible for that? And because rates are so low, because we're talking ultra low, what's the average mortgage rate in the UK these days? Probably around 2% a year, something like that, which, is absurd. I remember, back in the early 80s, people were borrowing in the teens. Now, imagine borrowing on your mortgage goes from 2%. Let's say interest rates go up by just 1%. So your mortgage goes from 2% to 3%. Well, suddenly everyone's interest bill on their mortgage goes up by half. Let's say interest rates go up by a mere 2 percentage points. Your mortgage goes from 2% to 4%. Your mortgage cost doubles. Now, given the highly inflated property market and the huge mortgages that people have taken out over 30, 40 years in many cases, that's going to do a lot of damage to the economy. So what's the central bank to do? Well, or the government going to encourage the central bank to do? Well, it's obviously much more tempting to say, well, let's let inflation run a little bit. Let's deflate the debt away a little bit. Let's let wages go up a bit faster. Let's let prices go up a bit faster. And that £100,000 mortgage that somebody has suddenly, in real terms, becomes worth a little bit less. It's only 80,000 in 5 years' time or whatever. So I suspect they're more likely to let inflation run a bit, but keep the language along the lines of it's temporary, it won't last long, it's not a big deal, there are special factors, blah, 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 blah. But at the same time, while they're doing this, everyone's busy sitting on their inflatable boat on a big river, sitting in the nice calm area, but they're heading towards the rapids and they're about to go off the cliff. And one day, all these countries have to go off the cliff, because if you keep printing money, you keep adding debt, and you don't get to grips with this, while you've got aging populations demanding bigger pensions and more healthcare and all the rest of it, one day the numbers just won't add up, and the whole thing is going to spiral out of control. Timing that, difficult, but that's the way we're heading, I think.
You've mentioned those extremely low bond yields, especially relative to inflation. I think today I saw that the German 10-year bond yield adjusted for inflation is minus 4.25%. So it's an absurd level that cannot last. Now, there's two possible explanations for that as far as I can see. One is financial repression, which basically just means that central banks are keeping bond yields very low in order to try and help governments finance their debt. And the other explanation is that we're headed for a deflationary debt crisis, a classic 2008 style crash. Do you think that's plausible? Because that creates another possible sequence of events here that's very different, almost the complete opposite to the inflation that we've been talking about.
Well, I think it's possible to have another. Well, actually, no. I think it's probable to have another big financial crisis in the Western world. I think 2008 was a wake-up call. People have become very, very complacent because nothing really bad had happened for decades, except in emerging markets where everyone thinks that's likely to happen. But it will be a very different type of crisis. So 2008 was a leverage problem in that there was a lot of debt in the system, massively leveraged assets, speculative bubbles in real estate, and all sorts of other things, bonds and all the rest of it. And the banks were far too leveraged. I used to work for a big bank, and their balance sheet was leveraged over 50 times, which is just nuts. So the ratio of their assets to their capital was 50 times. I think they're now down to about 20. So the point being that the banks are in much better shape. They're actually, lots of things changed that forced them to be safer than they used to be in general terms. So I don't think it'll be a bank problem, but it could be a government finances problem. So if you have a government that has enormous debt, as all of them do, UK's debt now must be around 100% of GDP. I'm not sure which side of that exactly it is, but it's around that mark. Now, the UK does have one good thing going for it, is that a lot of debt's quite long dated. But if you have a government which has a lot of short dated debt, so it's debt that it has to pay back within a few months, a year, a couple of years, when you get to that point where it has to pay back the money and re-borrow to have the funds to do that repayment, if it has to re-borrow at a higher interest rate than it had before, then suddenly the interest bill starts rocketing. And we could get this kind of death spiral of governments getting in trouble, investors realizing they're in trouble, demanding higher interest rates, as in higher bond yields, to lend them money, meaning governments have higher interest bills, which means investors realize their finances are even worse, which means they demand even higher yields on their bonds. And you get this death spiral of governments having to pay more and more interest. And then you're in real trouble. And then you're getting into the point where you may not just have inflation, you may have very sharp, sudden devaluations of currencies. So, on a Monday, you might find that the pound is trading at 139 to the dollar, and on the Tuesday, you might find that it's trading at only $1 rather than 139. So, who knows?
One of the most interesting ways that I've heard you speak about this or refer to this is that the UK and the US and the developed world, we are now following the playbook of failed states. The idea that this is how usually less well-governed nations get things wrong. They have a central bank, which is nominally independent of the government, but the government gets in such strife financially and economically that the central banker is forced to choose between either bankrupting the government or going along with the government spending and triggering inflation. And it seems to me we're at the same threshold now in the UK, in the US, and in Europe, where central bankers face that same choice. Are they going to finance the government, or are they going to let the government go bust in order to protect their inflation mandate? Which way do you think they would choose in the end?
Well, at the moment, I think we need to watch the monthly inflation statistics that are reported, which themselves have some issues, and I don't think they're particularly accurate, but the general direction of travel, not just what's happened over the last year, but what's happening month to month, is the trend rising or slowing? Because we've already seen, annual inflation rates in the US of over 5%. And it'll be interesting to see how that evolves over the remainder of this year and into next year. And a large part of that, the reason for that is not just that commodity markets have been volatile, but that the money supply in the US has absolutely rocketed over the last year, much more than the UK, actually. I mean, UK has a problem, but the US is much more extreme. So that's one thing to look at. I think also we need to look at, going back to those commodities, and look at gold and look at silver and precious metals, that type of thing, because, as you say, all the currencies might be devaluing at the same time. So let's benchmark them against real things. Farmland could be another thing. If you suddenly see the price of that rocketing, then that would be a sign that these currencies are losing value. So this also presents a problem for investors, of course, because over half of the world's stock markets by value are US. Probably if you look at most people's pension funds or how they're holding their savings, most people will have quite a lot in the US market. And the US market is trading at very expensive levels, in my opinion. And I don't think that's a controversial view at this point. So it's entirely possible that might fall off, or have a severe, sharp correction at some point if there's a loss of confidence for some reason. Bonds offer dreadful value and are at risk of, again, losing money sharply if yields start going up, if there's some sort of panic in there. Moving into foreign currencies has its problems, because if they're all in the same place, then what's the point of moving into other weak currencies? There may be one or two exceptions, but not too many. So what are you left with? Well, you're left with real assets. So I would say, everyone, for my money, should have at least a chunk of money in sort of gold, and maybe some other selected commodities, or the producers of those, just as a hedge for the worst happening. And we don't know when that's going to happen, but it could happen at any time, really. If they continue down this route, governments overspending and central banks printing money with impunity, well, eventually they're going to get punished, and so will people that haven't taken steps to protect themselves ahead of that.
I quite like the sound of governments getting punished. Unfortunately, it's investors and, of course, the taxpayer who ends up paying for all of this. Rob Marstrand, you're the editor of UK Independent Wealth. Thanks very much for joining us. And to the people watching at home, if you're interested in more of what Rob has to say and you'd like to check out UK Independent Wealth, there'll be a link below this video to find out more about Rob and what he has to say. Thanks very much for watching.